A wonderful year for us, and we're very pleased with the results. The World Cup certainly did give us a lift. Our turnovers during June, which was the peak of the World Cup, were up about 25% on the previous year, which is a nice kick in the beginning of the year. And then during the year, we've done some good things, I think, in terms of being acquisitive. We've acquired some nice brands along the way, all fitting with our deliberate strategy of either being number 1 or 2 in their category, or that we can make number 1 or 2 in their category. Their contributions haven't been significant in this set of results, but we're hopeful that in years to come that they will contribute. But I think what's pleasing for us, and it's always going to be an issue in our results, is the fact that our big brands, or what we call our guerrilla brands, like Steers, Debonairs, Wimpy, Mug and Bean, is that they continue to perform, and last year they did an exceptional job.
With regards to the contribution to the overall growth and profits that we saw, you're talking about your most recent acquisitions not having much of an impact on the overall profit number. You don't give it to us in percentage terms, so can we assume that the biggest chunk came through from organic growth?
Absolutely, from organic, in other words, from our existing brands performing better, and obviously also adding new stores to the network from our existing brands. We opened 111 stores last year, and I think what we shouldn't discount is the fact that our supply chain business really did exceptionally well last year, and particularly our manufacturing business, where we achieved record margins up to about 11.6, which is the highest we've been in a long time.
With regards to the revenues, I mean, we're seeing revenues increasing around 11%. We've got headline earnings per share up around 17% or so. Can we expect these double-digit growth scenarios to continue going forward from Famous Brands?
I think it's always going to be a challenge. This year particularly, I think we don't have the benefit of World Cup, which is going to be make the target even harder to achieve. Then you've got the very big spike in electricity, which is putting a squeeze on disposable income. We hold our breath for the toll road fees in Gauteng, and then the price of petrol and diesel continues to flip-flop. And then right now there's quite a strong spike in the price of red meat, which might have to find its way through to the consumer. But I believe that for as long as we take good care of our big brands in particular, we continue to position them on a basis of value, and we do some interesting work in terms of trading formats and making those brands available to consumers and affordable. I'm not saying we can repeat these results, but there's every reason to be optimistic.
You're talking about significant input costs increasing significantly going forward. How much of that can you pass on to the consumer, and how much of that can you absorb?
I think we're in a very fortunate position in Famous Brands, because in a sense we are the destiny of the supply chain, and particularly with the business in the manufacturing side of the business. With a spike in red meat, for argument's sake, right now, I mean, we can make deliberate decisions to absorb some of that margin ourselves and protect the end price to the consumer, which we do frequently, and in fact we're doing that right now. The price of red meat has spiked quite significantly in the last few months, and we're subsidizing that price in terms of protecting our franchisee margins and also keeping the price down to the consumer.
But you import most of your meat, if I'm not mistaken.
Most of it's coming from Namibia, and then a little bit from foreign countries. Yeah.
With regards to your UK operations, and you're talking about a very tough environment. In fact, some of the most difficult challenges experienced over the past decade. Some would say you've got a very strong footprint on the emerging market space. Why delve into UK, and why stay in that scenario?
We always said that if we wanted to get into a first world market, we'd do it by way of acquisition or JV. The Wimpy business proposition presented itself a few years ago. It's a brand we know exceptionally well. It's a brand we've done a wonderful job of in South Africa. And so what it did was it gave us some critical mass in a first world market, and also created a beachhead for us to launch some of our other brands. And so we're about to launch Steers, for argument's sake, in the UK later this year. But notwithstanding the fact that the economy is tough in the UK, the Wimpy business in the UK, we still continue to make money. It's a profitable business. We've right-sized the business now. We've got the margins up to a record 11.7%. And what we can't control is the economy. What we can try and manage it. And so I'm confident is that what we've got over in the UK now, once the economy turns, we'll be well positioned for growth. We're not going to exit the UK. We want to stay there. Deliberately we want to stay there. It's a profitable business. There's no reason for us to get out.
Yeah. With regards to the rest of the African continent, we know that there's a lot of logistical challenges. Of course, we know that your supply chains here are very strong and you've got a strategy in place. What about West and East Africa? a world of opportunity, but obviously met with a lot of challenges as well.
Absolutely, but we this year are absolutely going to continue with our push into Africa, and we're going to focus specifically on Nigeria, Zimbabwe, and not quite Africa but Mauritius. I've just come back from Nigeria 2 weeks ago with the political settlement that's just been managed over there, and the marketplace now got some political stability. I'm very excited about the opportunities in that part of the world.
How many more stores do you plan to open up in that region? What is your strategy? I'm sure you've got a few things jotted down.
It's difficult to predict because the marketplace over there is not as predictable. But we do have a footprint there with Debonairs Pizza right now. Debonairs Pizza is doing a phenomenal job in South Africa in terms of consumption per capita of pizza amongst the black consumers. And so if we got it right in Nigeria, I think that we'd surprise ourselves.
With regards to your consolidation phase, a lot of investors out there saying, well, you've been on the acquisition path, that's been very aggressive. Now most are expecting consolidation to occur. Tell us a little bit about that strategy, I mean, in terms of head offices, product ranges, supply chains, and so forth. Are you on that path, firstly? And secondly, what can we expect?
Look, we've got to spend time integrating these recent acquisitions into our business. There's work to be done on brands like the Keg, for argument's sake, which we're about to completely relaunch in about 2 months' time. There's work to be done on the Milky Lane brand. Milky Lane is a wonderful product. It's probably one of the best kept secrets in South Africa. And we tend to get consumers to fall in love with the brand again. So there's work to do. I don't want, though, the comment about consolidation to be misconstrued as us becoming conservative or complacent. I think we've not lost our mojo for growth. Growth is always going to be a key strategic driver of our business, and if the investment proposition makes sense, we'll do it. We have a very strong balance sheet. Our gearing is down to an all-time low of 14%. We've got wonderful leadership in the business and a strong business model. So, you know, we will continue to pursue growth, but not just growth for growth's sake. It must unlock value for shareholders.